welcoming Parag Thakkar into the conversation. He's, of course, head fund manager of Fort Capital. Just a quick check on the markets before we move forward. We're sort of middling along today. We're having a quiet kind of a day, a consolidation day on Monday. What's hurting, if at all, are IT stocks. The Nifty IT about 1.5% down. Broader indices not half bad. I want to pull up the advanced decline ratio just for a second to show you what's working today in terms of the broader markets, and that's at least you have an outweighing of advances versus decline. So maybe portfolios are not looking so bad today. But Parag Thakkar, before the break we were speaking about Hyundai. I'm told you have a view as well, so let's start with that.
Yeah, so Hyundai, I would like to add one more point. Some of the people have said that, from short term, yeah, definitely there is no big trigger. But just to have another view, that as you know, that we have spoken about TVS and Mahindra in the past, and we were holding those stocks in the portfolio. Hyundai looks interesting from medium to long term perspective because the starting valuation today, if you see the market cap is around 1,50,000 crores, and they have already generated 7,500 crore cash profit in FY25. So 5% cash flow yield. Now 5% cash flow yield to start with in FY25, that is trailing, is a good starting point for a good brand. Net cash of 8,600 crore in the balance sheet. And now they are talking about aggressive launches of 26 new launches by FY30. So at least there is a roadmap, there is a intent of company to grow. And regarding this market share loss, I would say that because their current capacity is 91% utilized, by giving lesser discounts and improving ASPs, if they can improve margins, which I think adjusted for one-off also their margin in March quarter was 13.5%, which I don't feel is a problem because their capacity is already 91% utilized. So I would say that it's a good addition. And coming back to my other point that the one clear theme in the market, of course, it was defense till today morning. But I would say is a rate sensitive, right? Because we have seen CPI, WPI numbers. We are seeing oil at 65. So rate cuts are given. So there are some real estate stocks or auto components which you have to buy in the portfolio. And Hyundai represents a good opportunity in my view.
Okay, so Hyundai represents a good opportunity, says Parag Thakkar. And like I said, the mood seems to be changing for the stock. Its market share has been robust, but the street did not welcome it as was expected, perhaps because of the pricing of its IPO. Nevertheless, things are turning after their numbers. Now, another set of stocks which is in focus is HEG and Graphite India. You'll see them as some of the sharpest gainers today in trade. This is because Japan's Resonac Holdings has announced shutting of its graphite electrode plants in China and Malaysia, citing global supply constraints. Now, the move is expected to boost margins for Indian players. Varsha is joining in to explain exactly why. Varsha, how does this help a graphite and an HEG?
Yes, so thank you for that. So first is why Resonac is shutting down its graphite electrode plants is because of the margin pressure that they are seeing. Now Resonac is a major producer of graphite electrodes, scaling back to improve margins, and because of the high competition that they're seeing from the low price Chinese parts. Now coming to Graphite India's global reach, if you see, they export to 27 nations, drive 35% of their turnover. Graphite India owns a fully owned subsidiary in Germany, and export accounts to 35% of the total turnover of the entity. When it comes to HEG, HEG exports over 70% of its production to more than 30 countries worldwide, and HEG is India's leading graphite electrode manufacturer, and the graphite segment accounts for 80% of the revenue for the HEG. So, because of the good market share that both of these companies have when it comes to export business, this is the reason why both of these stocks are buzzing in trade today.
Thank you so much for that, Varsha, first off, that perspective. But let me quickly take a view as well. Parag bhai, some of these businesses are extremely commoditized. So when you're looking at such a core commodity play, would it be fair to jump on this bandwagon? Because we've seen, at least over the last 12 months, some of these stocks spike in similar fashion at least 2 to 3 times when I'm looking at the stock chart. Is this just par for the course when it comes to some of these counters?
See, yeah, as you very rightly said, these are very, very deep cyclical products, companies, right? And there's nothing wrong in the company. It is the business is cyclical. So I would say that Graphite has a very good balance sheet, but definitely I would like to within the cyclicals, within the global cyclicals, I would say, I have always preferred Tata Steel and Hindalco as the stocks to go for. And domestic cyclicals, you know my view. We have been discussing cement since long. So I would not take too much of time there. But I would say I completely agree with you. It's a very deep cyclical. You have to study. Once in my experience of 21 years, there was one particular year where this stocks actually gave 700, 800% return in a year. Otherwise, I don't remember any particular time where they have given consistent returns because the business is such. And this, Japan company shutting down the production and so the prices going up. I would wait for more data to come. Of course, by then time the stock might have rallied, but unless I understand the situation completely, I would not form a view and buy.
Okay, okay. So stay away from cyclicals, says Parag Thakkar. I'm just wondering if you're feeling like that about defense at all in terms of the kind of boost that we've already seen and valuations that some of these stocks are sitting at. Parag bhai, I know we've been speaking about it for a while, and you said last that maybe defense stocks have become too rich right now. Do you see that continuing?
Basically, we have booked profits, actually, I would say, in this rally. And
are you regretting it at all, looking at where the trends are going and the kind of numbers that have come? We, waiting to see what BEL looks like, but Zentech at least.
No, I don't regret because we have sold on every rise, so it's okay. It's okay to. I'm happy to miss. Just let somebody else earn.
Okay. Happy to miss a few, I'm sure. Himen, do you have a quick technical view with with regard to some of these? Is there scope for some bit of more upside, if at all, in the near term?
Yes, I think so. I spoke about HEG and graphite. So I think you also mentioned every year, I'd say every couple of years, there's that mad move and then it fizzles out. So, yes. But you're absolutely right. When I saw it closer, you were right. It happens every year also, yes. So frankly speaking, yes, I think if you look at HEG, it's come off a bit from the day's high. I think there is some more headroom left. And as far as graphite is concerned, we have space up till 623. So yes, I believe there is some headroom left for an upside from current levels. Yes.
Now the other one that's doing fairly well in trade, much more than fairly well actually, after a decent set of numbers, was Delivery. Stock is still up, perked up 9.5% as it declared its Q4 numbers. Robust focus on operational discipline, it seems, this time around. We'll go across to Mahima, who's here to break down how Delivery has fared in Q4 and the reasons for that 9.5% up move. Mahima.
Right. So I think what the street is actually enthused about is the kind of substantial margin expansion that has taken place for the counter. EBITDA was also a significant beat despite revenues not, revenues seeing a single-digit odd growth. And the part truckload business is something that has contributed significantly towards margins as well as the overall growth in terms of EBITDA. Express growth, however, express delivery growth has remained tepid. In terms of numbers, revenue growth was at 5.6%. EBITDA stood at 119 crores versus that of 45 crores. So it's almost more than doubled. For margins, they expanded to 5.4% versus that of 2.2%, and net profits stood at 72.6 crores versus that of loss of 68 crores. So the company is also, turned into profitability versus loss last quarter 4 FY24. Now, in terms of what has led to growth, part truck volumes were up almost 19% and it was up 24% in terms of its revenues. Express delivery margins have also improved, and this is due to mid-mile utilizations improvement. Freight handling margins have improved due to lower contractual manpower as well as line haul expenses. In terms of what brokerages are penciling in for this particular counter, Goldman Sachs has maintained neutral but hiked the target price to 325 from 290. What they're saying is that margin sustenance over the next few quarters would be a critical thing to watch out for the stock performance. performance. Morgan Stanley has also maintained equal weight and with a target price of 320. What they're saying is that express parcel volumes and yields were lower than estimated, but the overall part truckload business revenue did beat versus estimates. And lastly, other business performance was also a miss in terms of what the street was expecting or what they were expecting. So this is the overall view as to what has worked for delivery.
Okay, so that's the take coming in for delivery. Thanks so much, Mahima, for breaking that down. Parag bhai, how should one look at delivery? Contextualize the valuation as well for us, in your opinion.
Basically, I have seen the result. The results seem to be good, and they seem to be, as you rightly said, focusing on operational discipline. And almost all the businesses which were burning cash are now, after getting listed, investors want them to show profits, at least at the cash profit level. That means including depreciation. So I think delivery seems to have done well on that front. And remember, this is a very high operating leverage business. So if you, as you were, Mahima was saying, that part load business has grown by 19% in volume terms, that would have helped them. But just a disclaimer, we don't have this stock in the portfolio. As I told you, I generally believe in market cap compared to the cash profit which company generates. And so up till now, it was out of the radar. But after this result, definitely I would have a look at it.
You know, we were discussing this, Parag bhai, and I just wonder if you have a take, if there's any comparative, no clear peer for delivery like you have, say, for an Eternal, Swiggy, etc., or, the platform companies. But in terms of the performance of a platform company, high cash burn, no clarity on paths to profitability, do you think that's where the positive surprise for delivery lies?
Yeah, definitely. Yeah. So delivery numbers were decent, I would say. So as I said, that it was out of my radar from the cash profit perspective. But definitely after this result, I would deep dive into it.
Delivery worth looking at. And in the sphere of platform companies, Hemen, any view on a delivery or any of the others that we mentioned, depending on how much data you have for them? Eternal, I'm sure, has enough.
I think I was just looking at delivery, Tamanna. Setup has, it's the worst is over, at least technically speaking, from a medium-term point of view. Thing is, okay, the markets have also been pretty volatile, but 240 to 367 in just 6 weeks, I would be slightly reticent about going fresh longs. Below 340, there's a gap. I don't know whether that gap gets covered up, but till it's open, there is a fear that it just might. This is just around 330. So if it comes to that level, I think that's where I'd take a contra buy call. Currently, it's not a short, it's not a long.
Okay, not a short, not a long at this time. BEL, though, is something that we should talk about. Bharat Electronic is set to report its Q4 earnings. Anushi is joining in to tell us what the street is penciling off its highs. BEL started pretty robust. Anushi, what would analysts be looking for very closely when the numbers come out?
Right. So, Tamanna, if you are looking at Bharat Electronics, now they've already come out with the FY25 provisional update, in which we did see about a 16% of a growth in its revenue at the mark of 23,000 crore. So this brings our revenue to a figure of 8,380 crore, which is a downtick of around 2.1% as compared to last year. Well, that's where, of course, the audited numbers may be slight bit different as to what the numbers are, but it's the margins which should be in focus. Now the expectation is of a 25% odd margin as compared to 26.7%, while net profit may see about a 2.4% of a decline. Now do note that the company already came out with its order book position wherein they had received orders worth about 18,175 crore. This is for FY25. This is versus the guidance of 25,000 crore, missing their FY25 order guidance by about 26%, owing to a couple of defense delays that had taken place from Ministry of Defense. If you take the console order book into perspective, that stands at 71,650 crore. Now the key monitorable here would be, of course, on the order pipeline. Your order inflow guidance, which is given, is in a large value pipeline that we are looking at, almost a 50,000 crore of an expectation as compared to 25,000 crore that we saw in FY25. 2025. And this order pipeline is particularly interesting post Operation Sindoor, in which BEL has played a critical part. We've seen about the ICCS system, about the Akash Tir, how that were utilized. So prospects for the business going forward from both the domestic and the export sides would be something that we should be watching out for. FY25 export revenue had seen about a 16% of a growth. So considering even the higher defense spending that's happening in Europe, how the exports are going to shape up for the business is on a watch out for. Key order expectations for FY26 remains 25 to 30,000 crore of orders related to QR SAM. That's quick reaction surface to air missile, along with next generation Corvette orders to the size of 14,000 to 15,000 crore. And even the order slippages that we saw in the final quarter of FY25, those order slippages at the tune of 6,285 crore may also reflect in the first or the second quarter of FY26. So all these points are very important for BEL, order pipeline being the biggest focus for the business going forward.
Bharat Electronic in view. Hemen, would that make it to the cut for your STBT or BTST actually calls for the day?
Frankly speaking, a small cool off. So it's not my call, but yeah, if I were to do a PTST on Bharat Electronics just for today, it would be a STBT, Tamanna.
STBT. Okay. Okay. So Bharat Electronics there. What are your other candidates for calls for the day tomorrow?
Yeah. Now I actually had a sell call on Coforge in STBT, but I'll have to tweak the figures because it's changed in the last 20 minutes or so. So currently, Coforge is around 8289. I would have a sell at 8290, stop loss of 920, and target of 8230. Stop loss 30, target 60. I'll have to tweak the figures a bit. Tamanna.
Okay, interesting call on Coforge at a time when, I don't know, IT is having one up day, one down day. I don't know how that pans out at all. But Parag bhai, a view on IT stocks, has all of that joy about the US-China deal and, trade war easing seems to have evaporated fairly quickly today?
I think today IT stocks are down clearly due to the fact that US rating has been downgraded by Moody's. So I would say that I am of the view that the IT spending, the discretionary spending, is not going to come back in a hurry for this year. But definitely once all these trade wars and trade tariffs settles down, it will come and then it will be a big comeback. So I would say that I am equal weight on the IT sector, as I said, with TCS, HCL Tech, and Emphasis says by stock picks. One another thing which I would like to add here is that HCL Tech and Emphasis, for example, or even TCS, they had a record deal wins. And HCL Tech was very clear in saying that they were very, very confident that all this deal will be actually executed and ramped up. So I would say that the companies who have done good deal wins, who are in right spaces, for example, Emphasis, 50% of revenue comes from BFSI, which seems to be doing well. So in any such large, I would say, downtick for IT, I would say that some of this, because IT is a great business, it throws so much of cash, the dividend yields are 4%. So I would say that don't ignore the big falls in these IT stocks. And these three stocks are the stocks which I like, and they are in my portfolio. So I would say that. But I think the key theme still remains rate sensitives in my view.
What is your top IT pick, Parag?
HCL Tech, I would say.
HCL Tech.
Yeah.
Okay. HCL Tech remains on top. What about you, Hemen? I mean, apart from Coforge?
I think this was a short STBT, but I think BSoft is something where I would be slightly more positive on. Hasn't done much, oversold, downside limited, the higher top, higher bottoms, indicators buying, weekly base. So I would look for a BSoft vis-a-vis the other stocks.
One in focus was NCC. An interesting note because CLSAs maintained their outperform, target price being 315, so very solid upside from here that CLSA sees. Q4, they believe signs of stability, but guidance being cut, possibly a negative. The pipeline, though, continues to be lofty. They believe the guidance seems to be conservative. Any volatility in a cyclically weak possible FY26 could be an opportunity to add, they say. And they believe that government water and urban infra programs should create years of growth visibility for something like an NCC. Parag bhai, if I can ask you, one, with regard to infra in general, two, with regard to NCC, are you bullish? Stock up 3.5%.
No, just a disclaimer, NCC I don't have in the portfolio.
Sure.
But I would like to say that this company has shown a good financial discipline. If you remember the days of 2007, when there were many other companies like IVRCL, Gammon, various other companies were listed, EPC construction companies. Some of the companies did big mistakes by venturing into real estate. Some companies got over leveraged. And finally, NCC actually survived through that cycle. So I will give full credit to NCC management that they survived through this very bad cycle, and then they took a good decision that they will not own assets. They'll just do a EPC construction. Then they reduce debt also. So all good things they have done. I was also very bullish at one particular price. Right now, I don't own in the portfolio. Right now, within the infra space, I own just L&T in the portfolio. And that is my stance. So I'm not very, very bullish on this sector as of now, but continue to like L&T and have equal weight in L&T.
Okay, point taken. What about PSU banks, Parag bhai?
So PSU banks are, again, I would like to share that I have SBI in my portfolio, and of course my top holding is the private sector bank, which is Federal and ICICI. But PSU banks, there are two things, right? One, valuations are always compelling in PSU banks. Asset quality is likely to remain stable, no problem. The only worry which I have in PSU bank is NIM compression, because 50-60% of, or for example SBI say 40% of the loan book gets repriced when the repo rates are cut, right? And deposit rate, of course SBI has cut 20 bips yesterday, which will give some cushion to their margins. But I would say that how long you can continue cutting deposit rates, right? Ultimately, at some below 6%, 6.25%, I would like to see that, how much growth how much growth happens in deposits. Because in India, remember once Mr. Uday Kotak also said that below 6%, nobody wants to keep money in India. So that is a limited cushion over there. So I would say that, and of course, some NIM compression will get offset because of the treasury gains, because 10-year bond yield has also fallen. So some of these PSU banks will have cushion. So I would say that it's a mixed view, but again, valuations are very, very compelling there. Especially in banks like SBI, Canara, Union.
Any of the private names, private sector names, Parag?
Private sector banks, Federal, ICICI continue to be, Federal is my top pick actually. And I always said that this is a bank which I have taken with a very long-term view. With a disclaimer, because of course, your viewers can take the advice of the financial advisors. But here the valuations are at 1.1, 1.2 times PE of 10x, with a new CEO coming from Kotak Mahindra Bank. I would think if you just go let this FY26 go through, because if the rate cut cycle, it is very difficult to improve ROA in this rate cut cycle. But once the rate cycle stabilizes, you will definitely see the ROA improvement. They are already building up bank for higher yield loans, which will improve their ROAs. For example, credit card and personal loan. Recently, the person has come from Kotak Mahindra Bank. So I would say that it's a good long-term hold for me always, in my view, because the valuations are very, very compelling. And I have full faith in management that they will improve ROAs once this rate cut cycle is over.
Okay. Thank you so much, gentlemen, for joining us this afternoon, giving us all of those views and taking out valuable time.